eating a lot?
Yeah, so much. Like last night, I probably went for thirds.
Wow. You eating protein-rich stuff?
Yeah. Last night was beef.
That's start. That's something's not right.
It doesn't have to look right, man. It's right.
Okay. If you say it's right, then it's right.
It's right.
Okay, we got somebody. Peachy, what's up, Peachy? We just started. We're going to teach you how to get a house in 2024. We're going to tell you about the zero down programs. And we're going to tell you about your debt to income ratio, what your credit score should be, what's the lowest down payment you can get in a house for. We're going to teach all of that to you, Peachy.
Okay.
Whoever else happens to be there.
Do you have shitty credit? Do you have great credit?
Damn, you're gonna open up like you're coming in hot, dude.
Do you have no money?
Damn, super hot.
Do you have no job? Do you have a
Damn, you're like, you got no credit, you got no job, you got no money, you got no hope in life.
Are you working for CNN, man? Are you pulling out as the negatives?
I guess so, man.
I said if you make great money. I said if you have great credit. I said if you have a lot of money, as well as the bad stuff. All of you count. All of you count. And so do your questions, so I need you guys to load up the chat box.
What's up, Bonsall Thomas? Great to see you. We're here to help you get a house in 2024. We are licensed loan officers. We deal with loans all day long. We know the guidelines pretty darn good. 99% of them we can quote off the top of our head.
Occasionally you throw us for a loop.
Yeah, occasionally we got to go back and go, I got to check the guideline on that.
Not often.
And the fact is they change. But if you want to get a house, we can tell you that you can get one for 3.5% down on an FHA. You sure can. You can get one for 3% down on a Fannie Mae or Freddie Mac. You sure can. You can get it for 0 down on a VA. You better believe it. You can get it for 0 down on a USDA. Holy smokes, is that real? It's real. There's a lot of stuff going on. Interest rates, they're not the best in the world. They're not. They're horrible. But there's a weird benefit to this, and that is it becomes a buyer's market. What? Right. Buyer's market? Buyer's market? Jeff, how can I avoid 20% on rental properties? There's a way, but it's a real tough way to do it, Jeff. Real tough. Like real tough. If you have a really great FICO score, like 800, I do have one DSCR program that'll do it for 15% down. But short of that, you're going to probably have to put 20% down on all of your investment properties. And here's why. All loans are based off of risk. The bank is worried that you are going to default. So what does that evil bank do? What does that evil bank do? They throw in logic and reason. They say, hey, listen, if you live in that house, it's harder for you to default. That evil bank says, you know what? It's harder for you to default if you live in that house. So because it's harder for you to default, we'll let you get in with FHA 3.5% down, Fannie Mae 3% down, Freddie Mac 3% down, and USDA 0, VA 0 if you live in that house. However, if you're going to rent that house out and make an income off of it, we're all for you getting rich. We really are. The banks are. Chris and I want you to get rich.
Absolutely.
We do want you to get rich. We do. But the banks are not stupid. They're like, okay, if something goes bad, who's going to eat it if that guy defaults on the loan? Oh, I am. Holy smokes. What can I do to mitigate that risk? Well, all I'll do is just say, hey, Mr. Investor who wants to buy an investment property, we need 20% of your money, and then I'll lend you 80% of my money.
Yep.
So that's the reason. All loans are based off of risk.
Know this, Jeff. So you're going into a world of investments. You're becoming a business owner using someone else's money. That's a big deal. Where else in the world can you do that? Well, once you've established yourself, you can get SBA loans. You can get loans against your business and all kinds of stuff like that. So this is a big boy game, and you're playing with big boy money. And you got to come in with your piece. That's the truth. I hate to tell you that, but that's the truth.
My score 609 on Experian. My spouse is 740. We want to buy a house. Is this possible? Name. I can't see the name.
It's Giselle, man.
Giselle. What's up, Giselle? I like the way you spell that too, Giselle. Hey, Giselle. Here's the catch. It's good news. Good news. Bad news. Okay. So, For a long time, it was your credit score and your spouse's credit score, and then we take the minimum of the two. But about 3 or 4 months ago, there is some option called blended credit. Blended credit, if you're legally married and you meet all of the requirements for the specific loan program, we may be able to take your 609, throw it into a bucket, his 740, throw it into a bucket, and then pull out whatever we get out, the middle of the two. So we're able to use what's called blended credit. It's a new feature, but yes, we can move forward.
Okay, so Giselle, here's another piece. Do you have income? Because that's a big deal. Do you guys work? Do you have assets? Do you have money? Do you have something to put down? Because that really helps you too.
I missed all those things. All I was talking about was credit. All I was talking about, well, there's only 3 legs to a loan. 3 legs, that's it. Credit, probably one of the most important. Probably because that's the yes you can or no you can't. Income, that's how much you can or how much you can't. Everybody thinks yes you can, no you can't. Well, you know what? If you got 40 grand, I can qualify you for a house. Just not an expensive house, but I can qualify you for a house. And then assets. Assets are how much do you have for down payment and reserves. So those are the 3 legs to a loan. Credit is probably the most important.
He hate 'em 3. I have a pre-approval 700K here in Riverside County, but something is telling me to talk to you guys.
You know what it is? He hate 'em 3.
It's
It's
us.
him. It's him. He's telling you to talk to me, and I'm telling you to talk to him. What? Yeah. He hate him 3. Even if you've got a great pre-approval, you might. It's great. Go ahead.
Here's something that you need to know. He hate him 3, and nobody knows this except all our millions and millions of fans who are watching us. But when you put in a pre-approval, who that approval is done by is a big deal. And here in Riverside County, the Chris and Lee brand is very strong. So if you put in an offer with our name on it, maybe your chances of getting that house increases.
We've actually gotten offers accepted because they know us. There've been a lot of people. We know you. We see you out there all the time. We know you close loans. If these are the lenders, we're good to go.
Yeah.
A lot of loans fall apart. I'd say 30% fall apart because of something wrong that didn't get caught in the beginning.
And the loan officers out there hate us because
They ain't us.
there you go. Jeff, I've lived in other investment properties. I've lived in other people's homes
Yeah,
too.
I lived in. He did the quote air quotes.
Yeah.
Except it's not air quotes. It's actually this. You're correct, Jeff. If it is your primary residence, you can use the system, and there's actually a hack.
You're saying no sound muted.
Uh-oh.
Someone else can
Give me 1 second. Everybody was hearing me for a second. Maybe it's if you can hear. Miami is good. She says it's good now. Okay. Cool. Yeah, if you live, the hack is simple. The hack. If you buy a 4-unit, you can go to 4 units. 4-unit. If you buy a 4-unit and you live in the primary unit, you are allowed to use, if it's your primary residence, FHA, VA, USDA, I think so, USDA, Fannie Mae, Freddie Mac, all of them, as long as you live in that primary unit. Where it becomes a question is if you already have a VA or an FHA loan, because they're not automatic. They're not like, hey, I got my VA in this side, my FHA in this side, because the truth is, they're both government. Yeah, they're both government.
Here's the great news, man. Here's the great news. Athena is an underwriter, and she says, here, these loan officers are 100% correct. Apply. Now, here's the good news. That if we're kind of off a little bit, she'll correct us.
We appreciate you, Athena. We appreciate you. Hey, we love when other loan officers come in, realtors, underwriters. Love underwriters. I fight with you guys sometimes, but we usually come to, I get the logic behind an underwriter. An underwriter has a high-level job to check everybody. They're not just on the side of the loan. They're like, hey, bro, I like you. I'll fund this loan. They got rules and reasons for doing what they do. And they're usually human. They're just, hey, here's why this is. Oh, okay, let me take a look at it that way. Oh, here's why this is. Most of the underwriters that I've talked to, if I make a good case, and it's not a bullshit case, it's not like, hey, his dog ate his income. If that doesn't fly. But if I can give a good reason why this happened, and I can get the underwriter to see it, like most of the time they go with me. Yeah. So much respect to the underwriters. So thank you very much for Athena. No sound, we covered that.
Athena, I got a question for you. So you are an underwriter from the loan officer side. We get to see the new applications coming in, the amount of inquiries, the people that are asking questions, so we can kind of have an idea of what the business is looking like in the near future. Mm-hmm. Are you seeing a lot of applications right now? Are you underwriting a lot of files? Yeah. Do you see new ones coming in? Are they having to hire underwriters, I know that a lot of companies are still laying off. So I want to get your pulse.
Mr. EJ. Hey, Mr. EJ. If you see that right, it rhymes. Hey, Mr. EJ. What does it mean to have an escrow shortage? Okay, so there's two types. One of them is when you're purchasing the house. If you're purchasing the house, you go into what's called escrow. And escrow is a non-biased third party that executes the agreement that all parties agreed to. So the seller agreed to sell for a certain amount, the buyer agreed to buy for a certain amount, the lender agreed to loan that certain amount, and as long as all those, then you're in escrow. So that's an escrow. So once that closes and you now are paying your payment, you have another account, which is an escrow account. And that escrow account impounds your property taxes and your insurance. Okay? The loan, if it's a 30-year fixed, will not change. The loan is going to be fixed for 30 years. It's not going to change. But that doesn't mean your payment won't change. Why? Because your property value goes up every year, and every year that your property value goes up, there's a new property assessment. The property assessment gets reported to the bank, and the bank says, hey, we need a little bit more money from you, and we should have collected it a while back, so there's a shortage. That's an escrow shortage. And then the bank has a way to deal with this. They'll either say, hey, you can write a check for $600 and you're back to good with a little bit higher payment. Or if you do nothing, we'll factor that $600 in, we'll increase the payment even more until you catch up. And then we'll re-review it next year and adjust it. Nobody's stealing your money. Nobody's taking your money. You're paying your property taxes. Your mortgage has remained stable. If it was a 30-year fixed, it didn't change. It's 30-year fixed. But what does change is property taxes and insurance. And most of the time they go up.
Yeah, and sometimes the data that's put in when it's originated by us, underwritten by Athena, sometimes after the fact, the county reports different data. So, yeah, you got to make those extra payments and you'll catch up, man. It will be okay. Athena, I'm an underwriter that works directly with an LO. Lots of applications coming in. That's fantastic news for LOs. That may not be the greatest news for you buyers, and here's why. As more people start coming into the buying sector, it becomes more tough because of low inventory, and then they start bidding wars. So if you haven't applied yet, Athena's already given us indicators that it's not going to be so good in the near future. So get yourself started. If you're interested, go to the link in the bio, click on apply for a home loan now, and start the process.
Can you explain on a USDA loan, living in a rural area, is it worth it, FHA or conventional? Okay, so yeah, here's what USDA is. What does it stand for?
United States Department of Agriculture.
That was a test. He passed it. All right.
100%.
So USDA, this is a special type of loan where they're saying, hey, you know what? This is an outside area of the metropolitan area, and we want more people to live here. How do we get more people to live here? Well, we give them favorable loan conditions. 0 down is a big one. So USDA will say, all right, we want people to start populating this area, so we're going to thumbs up to all these properties. 1, 2, 3, 4, 5. So then USDA actually approves the property. It's not you apply for a USDA loan and then you try and find a house. They approve the property first. So once we have a USDA approval, it basically goes into the guidelines of any government loan. It's going to be FHA, VA, USDA. They're all government loans. But we have to use a special underwriting system called GUS, Government Underwriting System, for USDA. So the USDA it's a good loan, but it's a loan. So let's say you found one Main Street that USDA approved. You can go USDA, but if it qualifies for USDA, you can also go FHA. And if it qualifies for FHA, more than likely to qualify for VA, Fannie Mae, and Freddie Mac. All of those. But the only one that will give you 0 down, if you're not a veteran, is USDA. So is it a good loan? Sure, it's a good loan. It's a loan. It's an option for you, but we run all the options. Most of the time, if we can go USDA, we go USDA.
Yeah, Athena said if you are here on these LOs, are strong, apply today. Let's work together.
We appreciate you, Athena.
Welcome, Mr. EJ. Okay, and Athena says USDA has a household income. It's a great loan.
It is it's a great loan if you can get it. But a lot of people are like, hey, I'm in the middle of Los Angeles. I'd like to use the USDA loan. Like, sorry, can't do it. Yep. USA didn't approve it.
Did you have mentioned the HUD.gov? or the USDA.gov for the map?
No, go.
Okay. So how do you know that you can get a USDA loan in your area? So of course you need at least a 580 credit score, to your work history, yada yada, the basics. But these are geographical. So what you would do is go to USDA.gov, and there's a map that'll tell you exactly where USDA is allowed. So those are the specific areas where you can do the loan. Outside of those boundaries, you cannot do USDA, but there is FHA, like you had brought up, Giselle, where you can get all over the nation. Plus, you're not limited on the type of property. So if you want a regular house, single-family residence, if you want a condo, if you want a manufactured home, you can also get those as well. So don't limit yourself on your choices, because prices vary all over the place, and the type of property price varies as well.
And she did ask me to explain the difference between USDA, FHA, and conventional. So most people, I'm going to give you, this is high-level stuff. Underwriter's going to tell me if I'm right or not. High-level stuff. Most people sit with a FICO score between 620 and call it 760. And 620 to 760, you're almost always better off with FHA if it's your first time, if your first home and you're a first time home buyer. Almost always. Why? Because the MI on FHA is set. If you put 3.5% down, it's 0.55. If you put more than 5% down, it's 0.50. Doesn't matter if you're rich, if you're poor, doesn't matter if your credit sucks, as long as you're qualifying, doesn't matter what it is. Now, when you get into that higher level FICO score, 780, 800, this is called 800. At 800, your credit is so damn good. It is so damn good that your MI is going to be tiny, like 0.21, maybe 0.19, which is way less than 0.55. So if you've got an amazing credit score, then you might be better off with conventional. It's all determined based off of the starting block is your credit score. So if you've got an 800, like if somebody says, hey, listen, I'm looking at a $300,000 house. I say, what's your FICO? 640. I almost always know they're going FHA. 800. I'm like, okay, I'm going to put FHA versus conventional, and almost always conventional wins if you've got that kind of credit score. But most people don't have that credit score. You know how I know? I pull credit every day. Every day. Whenever we see something above 800, we both talk about it. We're like, hey, got another 800 guy. A lot of people talk like they got an 800, and sometimes they'll have one 800 and then a 760 and a 787. Well, that's not 800. You had one 800, but your rule is 787. So that if it's going to depend on your FICO score.
Athena, as an underwriter, I look at the programs that fit the borrowers. You are correct. That's what we do. So when you come to us, I'll say, here's where you qualify conventional. Here's where you qualify USDA. Here's where you qualify FHA. Which fits you best for you and your family? We don't choose. You choose. Because you got to know all the particulars, and some might be better than the others for your situation. Athena also said you're correct, Lee. FHA for low score and high credit.
The underwriter keeps telling me I'm correct. I love that shit.
We know what we're talking about.
The underwriter keeps telling me we appreciate you, Athena. Thank you very much. Thank you, guys. You are great. Appreciate it. I appreciate the breakdown. Hey, listen, Leslie, if you're thinking about buying a house, first I'm sorry, Giselle.
Yeah, Leslie on the line?
Dude, I don't know. Giselle. If you're thinking about buying a house, the place you start is you call us or your loan officer, but I'd highly recommend you use him, and he'd recommend you use me, right?
100%.
Okay, cool. You know why? Because I give you all the data right here in front of the world and challengeable. My NMLS is 944254. His is
1066958.
We have to do that for legal reasons. So we do disclose our NMLS all the time. It's also on the thing here. But what we will do is we will have a conversation with you, probably 10 minutes, 5 minutes, 10 minutes, 15 minutes. And then from that conversation, we'll pull your credit. We'll collect all your data. And then we'll say, hey, listen, you want USDA? All right, well then this is the area that you're going to be looking at. Find the house and then let me know. We do different underwriting systems. We use what's called AUS, Automated Underwriting System. And that's going to have both DU, which is Desktop Underwriter for Fannie Mae, and LP, which is Loan Prospector for Freddie Mac. And then if we go USDA, we use something called GUS, Government Underwriting System. Any of these underwriting systems will give us the approval to send you shopping. So we can help you get that house. There are zero down programs. You can do a zero down program with FHA. They exist. You can do zero down USDA almost automatically. VA, zero down. Conventional Probably not, but there are some that might work.
All right, time for a commercial.
If you need a badass loan, call a badass loan officer. You can reach your badass loan officers, Chris and Lee, at New American Funding. But don't call right now because we will not answer. Well, you can, but we're not going to answer because we're live. Yeah, duh. After we're done with our live, you can call and we'll actually talk with you, have a conversation, and put together a plan for you to get a house. This will disappear in 5, 4, 3, 2, 1, bye.
Dude, I almost dropped it too early.
Dude, drop it like it's hot. Drop it like it's hot.
Fina, I would love to be your underwriter. These guys are amazing. I tell you, apply today. Don't wait, people. And she's right.
Yes.
Lee, tell them why she's right.
Because I'm amazing.
What else?
I'm also phenomenal.
Other than you, why should they apply?
Right now it's a buyer's market, even though it doesn't look like a buyer's market. Interest rates are high. They're like really high. They're like close to the highest they've been in 22 years. Sounds horrible. But here's what happens in the real market. If interest rates are high, there's less buyers. Well, if there's less buyers, that means that the buyers get to choose. Well, what does that mean? Well, let's say we have a $500,000 house, okay? And we're in a buyer's market. In a buyer's market, there's not a lot of buyers, so the buyers get to choose. Well, this guy puts the house on the market for $500,000. And in a buyer's market, they don't immediately get an offer. Why? Because the buyers haven't chosen it yet, and there's not that many of them. So a little bit of time passes, and now we're 30 days DOM, days on the market, 30 days DOM, and then this buyer goes, hey, I'd like to buy your $500,000 house, but I want you to give me a discount. If you have a skilled realtor, it doesn't sound like discount. It says, hey, I'll give you full price, but I want you to cover closing costs. What? You just said give me a $10,000 discount. That's what you said. And if the seller hasn't gotten an offer in a very long time, they'll go, I might not get another one for a while, so you know what? I'll cover your closing costs. I'll give you your $10,000 discount. And then boom, you got it. So that's in a buyer's market. Now let's flip the script a little bit. In a seller's market. We've been in seller's market for a long time. $500,000 house hits the market. Opening weekend, the weekend it went live, they did an open house. And they had 30 buying units go through it. 30 couples or people that could buy. 30 couples. That next Monday, the realtor has 10 offers. 10 offers. What? Then here's how the offers come in. There's always those super smart people that are like, hey, I'm going to lowball them and I'm going to come in at 480. 480 on a $500,000 house. You know what's going to happen to those 3 offers that came in at 480? Buy. We don't care. Buy. Thank you for applying. You have a wonderful day. I hope you get what you're looking for. That won't even counter them. The ones that come in at 500, you're like, okay, cool. The agent tells the seller, hey, we got 3 in at asking price and we got 3 in above asking price. So here's the 3 at asking. What do you think the seller's looking for? They're like, okay, those are nice. Let's not throw those away, but tell me about those 3 above. Well, I got one for 505, 505, and one for 510. Wait, what? $510,000? I think I want to go with that one. That's because we're in a seller's market in that situation. So even though it may not seem like it's a good thing, that higher interest rate, if you can afford the house, is the better situation for the buyer.
All right, guys, if you have a question, hang in there. We are going to get to it, and we are going to answer it. And this question that Sky and Vicky is asking used to really upset me.
Upset you?
Because I knew the answers, but I realized that what the data that's out there, and you get information from your friend and this person and my mom's grandma's cousin said. So it's never from the horse's mouth. But let me give you the truth about credit, Sky and Vicky. The question is, if you check the credit score, it will drop the score or not. Okay, so here's the answer.
Are you mad?
No, I got to educate.
Are you big mad?
I got to teach.
All right, teach.
I got to show the world what really
Dude,
is.
freaking teach, man.
So here's what it is, Sky and Vicky. So your credit, if you're making your payments on time, if you're keeping your credit card balances low, maybe even at 0, you're going to maintain great credit scores, okay? You're going to maintain those great credit scores. But if you miss a payment and then someone pulls your credit, your score is likely to be low. If all of a sudden you went on a shopping spree, maybe it was Christmas, and you put some debt on your credit card that you intend on paying off, and you probably will, and then you go to check your credit, your scores will be down. Pulling your credit once does not affect you. But if you go to Kohl's to save 20%, Home Depot to save 20%, if you go and get a car, if you apply for a couple credit cards and then pull your credit, the algorithm inside of the credit agencies, they're going to go, wait, this person's not showing a lot of discipline right now. And then we pull your credit and it's a little lower. That's when it comes in low. So making your payments on time is a big deal. Keeping your balance as low is a big deal. And not pulling your credit all the time is a big deal. A couple times a year shouldn't affect you. You should be fine. So that being said, Sky and Vicky, as long as you've maintained the habits of a person with good credit, you're going to be fine. Your scores will not drop.
And let me tell you why, Sky and Vicky. Here's one of the big things. I've known a lot of people to do this over my life. Hey, do you know what a strategic default is? Strategic default is, hey, I know I'm going to default. I know I'm going to declare bankruptcy in about a year. But before I do, I'm going to Kohl's, MasterCard, Sears, everywhere else that I can.
Sears still around?
Sears is online, dude. You know nothing.
Oh.
Sears. I'm going to go to Sears. I said Sears. I'm going to go to Target. I'm going to go to Walmart. I'm going to pull all these credit. I'm going to get some good credit lines. I'm going to run them all the way up. And then I'm going to default. That's called a strategic default. And if you think you're the first person who came up with this, you don't know about the world, Sky and Vicky. I know you're not thinking that, but I've seen this so many times. So when all of a sudden the credit agencies say, hey, here's a credit pull. All right, that's fine. That's cool. Hey, here's another one. All right, a little out of, here's another one. Here's another. Oh shit, this person's about to strategic default. The more credit pulls you have, the more probability that you're going to have a strategic default. And because of that, they go, all right, let's limit this by dropping the score. That's a big, big deal.
Yeah. So, and also, guys, let me get to Elite Gods. He's been waiting. Elite Gods, this is actually a really good question.
Elite Gods.
I like this question a lot. It's
Okay.
a very smart question. Do closing costs have to come out of your pocket,
Huge.
or can it be added to the loan?
Such a smart question.
Yes, I love it.
Never been smarter question ever.
Ever in the
I'm
history
trying,
of
man. I can't
mankind,
get- I
since
can't
the
hit
very
it.
beginning. You try, man. I
Yeah,
like
I'm
the way you
trying.
try.
I'm trying.
Here's what it is, Elite Gods.
All right.
Here's the good news. Okay?
Okay.
You're still going to pay for it, but it doesn't necessarily have to come out of your pocket. And here's the strategy. It's called stacking. Okay? It's called stacking. Here's what that means. Let's say you're going to buy a house for $210,000. It's listed for $210,000. And your realtor, who's a very good agent, does research on it, does the comps, looks at it, and says, you know what? This thing's worth $220. So what you can do is you can say, hey, seller, I want to buy your house for $220,000. I need you to credit back $10,000. And that's how you get your closing costs covered. They do not come out of your pocket, but you are financing that higher amount. It is going to be paid through the monthly payment. And $10,000, finance is roughly somewhere in the neighborhood of about $50 a month. So you are paying for it, but you can keep that $10,000 in your pocket going that way. Also, there's programs. There's programs that will help you pay for down payment and closing costs and other things as long as you qualify. So I hope that helps you.
And Elite Gods, here's something that you should probably know. Underwriter, check me on this. You have to come up with the 3.5% down. You got to come up. It's got to be your own money. It can be a gift from a family member, but it's got to be your own money. You got to pay for that. You got to pay for the down payment. They want your skin in the game. Do you know who has to pay for closing costs? Nobody has to. It can be anybody. Your realtor can set up and go, you know what? I'm willing to pay the closing costs. That can happen. Your uncle can say, hey, I'm going to give you a gift to cover the closing costs. You can ask your lender. You can say, hey, Chris, can you do me a favor and cover the closing costs? And you know what he'll say? With your 800 FICO score and your amazing income, why, sure I will. Now, do you think he's going to give you the money? No, it's ridiculous. What he's going to do is he's going to increase your interest rate so that you get a credit back to cover the closing costs. Can we do that? Yes, we can. So, closing costs can be paid for by anybody, but your down payment has to be paid for by you.
When you say anybody, give me a few options.
My uncle.
Okay.
Okay. The realtor.
Okay.
Don't tell them that. They'll get mad.
They get big
They
mad.
get big mad when they say,
But they have
hey,
no problem asking us.
yeah, they got no problem asking. Yeah, the realtor can come, and I've been in many a deal, where the realtor says, hey, listen, I'm willing to credit back $3,000 of my commission in order to make this deal happen. Of course, I'm in California where the average house is like $700,000, and they make a lot of money on a commission. So that does happen. It can happen. It can't be under the table, though. It has to be fully disclosed. It has to be, hey, listen, I'm putting addendum on the contract that says realtor will credit back $3,000 towards closing costs. That happens often. So that's your uncle, your realtor, your lender, who else?
Seller?
The seller can yeah, there's a lot of people that can cover closing costs.
Options, yo. You got options. Hey guys, I need your help. If you're liking this, if you like what we do on a daily basis, we need to get more people in here to ask questions. So please give us a bunch of likes. We're trying to get a lot of likes. I always aim for 10,000. Haven't hit it yet. But just keep tapping that screen. Give us a bunch of likes. Share this. That's the most important. Please share this to your feed so your friends, family, and whoever else in your For You page. And that is all. So where we at, Lee?
Athena, the underwriter, Athena.
Yeah.
Athena, the underwriter.
Isn't that a goddess?
So it is. It's the
Greek
goddess
goddess?
of love, I think. Athena's a goddess of love.
She's a lover.
Yeah. So when you buy a house, never open new credit. Yeah, we tell people. I'm like, hey, when I'm doing a pre-qual or somebody's going into escrow, I'm like, hey, I know you're in escrow. I have to say this. Don't open a new credit card. Don't get 10% discount at Kohl's. Don't do anything. Don't pay off your car. Don't do anything without talking to me because it could hurt you. Hey, I paid off my car. Yeah, but you needed that for reserves. Yeah, that was $14,000 we needed for reserves. Lee, this can only be better for my FICO score. No, you passed FICO a long time ago. You're good with FICO. I needed that reserve. I don't know how I'm going to tell this to the underwriter. Then I have to talk to Athena, and I have to go, hey, they thought they were doing good. They paid off their thing. And then Athena's going to have to go, oh, no, Lee, we needed that for reserves. Oh, you know what? With the new debt-to-income ratio, after they paid off that $800 a month payment, I don't need 6 months of reserves. I only need 2 months. That's a real conversation. That happens.
Here's another thing with the transactions, guys. Always be open with us. Okay, open. Tell us everything that's true, because we want to make sure that when this thing gets to Athena, that she's going to say, of course you're going to get approved. Yeah. Chris and Lee packaged this perfectly. It looks great. It looks very good on paper. But Athena, I've got a question for you. Because a lot of people want to be sly. A lot of people want to be slick. Because here in California and many other states in the union, you're in community property states, you must add the husband and wife's debts to the federally insured loans like FHA, VA, USDA. Okay, but a lot of people like to be slick and go, "I'm not married. I'm not married. I'm single." But it always gets found out. Let me know if I'm right, Athena, and let me know, how do you find it? How do you find these people that are married when they
Statement of identity, man. That's it. It's a statement of identity.
There's more spots. I want to know Athena's.
Largest conventional mortgage you can get with 75K income, 0 debt, 17K down, 671 FICO. So in that scenario, why would you go conventional? First question. Why? You should go FHA. Now, I don't know if you know the difference between conventional. Conventional is actually a category. Conventional is a GSE, government-sponsored enterprise. I used to say entity, but it's enterprise. So it's a GSE, government-sponsored enterprise, and that's Fannie Mae and Freddie Mac. But there's another loan out there called FHA, Federal Housing Authority, and Federal Housing Authority has a little bit more lenient on your property. So if you really want to know conventional, if you have a 671 FICO, I can get a Home Possible at 71, right?
Yeah,
671 Home Possible, Home Ready. So you would need 3% down, so your 17K would greenlight you for about 500,000, maybe a little bit more, 500,000. However, your income is going to throttle you back to about 300 on a conventional, maybe 290 on a conventional with a 671 FICO. If you went FHA, you're probably going to crack 310, 320. That's just basic math. I mean, I'm not offering you to lend. I got to pull your credit. I got to do your income. I got to calculate your income. I got to check your assets and then give you an offer. But it's a ballpark right there. And you may want to think about FHA.
Yeah, Garcia said just because buyers seem to want conventional. Let me elaborate on that GRCA. I think it's Garcia.
Yeah.
So here's what it is. Agents need to educate themselves a little bit on loan programs, a little bit. And every agent should have a preferred lender. Like we have a long list of agents that we work with that turn to us for everything. I recommend if you're an agent on here, turn to your loan officers or give us a call. We'll help you out. But when it comes to the difference between FHA and conventional, a lot of agents have this weird understanding that FHA is not gonna go for it. FHA is not gonna work. There's only a couple reasons why FHA doesn't work on a property. One, If it's a condo association, it has to be FHA approved, which we find out all that data for our agents. 2, if it has health or hazard issues, okay? So if this house has exposed wiring, if this house doesn't have proper flooring, if it's not really move-in ready and safe, FHA, the appraiser's going to go in there, do an inspection and say, I need this repaired, this repaired, this repaired, and that's it. But that's a good thing for the buyer, especially if it's a young couple with a couple of kids, first house. We don't want to put them in a situation where there might be an issue and the kid might touch something and get electrocuted. We want to make sure it's safe. So it's actually a really good program. But agents believe, because the appraiser might call out this repair condition, that it's just not going to work out, so we must go conventional. Now, the challenge with that is, if you have a 620 FICO score, you might not get approved conventional. You might not. You might, but you might not. But it's solid FHA. So this is just a little bit of education that the agents need, Garcia. So if you have any challenges with this, or if your agent needs some help, we can definitely got him in the right place.
And here's a little more, Garcia. When a lot of realtors, they look at things like, hey, I want to put a deal together. One of the hardest slaps I ever got as a baby loan officer was this. I got an appraisal. We got, hey, we're in contract for $500,000. I was like, that's amazing. Yay, everybody, $500,000. That's awesome. And then the appraisal came in at $480,000, and I panicked. I was a brand new loan officer. I panicked. I was like, oh my God, it came in $20,000 below. What are we going to do? Oh, shit. So I went straight to the owner of the bank. That's what I did at the time. So I went straight to the owner of the bank, and I was like, hey, I've got a problem. This is a big problem. It's gigantic. It's enormous. He's like, okay, what? And I said, well, we're in contract for $500,000, and the appraisal only came in at $480,000. How can I get this up to $500,000? And he says, I'll tell you, but first, I want you to answer this question. Why would you want your borrower to pay more for a house than the market says it's worth? Answer that, and I'll tell you how to get it to 580 or 500. And I sat there just dumbfounded. I was like, I can't answer that. And he goes, go ahead and think about it, come back. So I went back and I was like, okay, the market is 480. These guys were overzealous trying to price it at 500, and the appraiser did not agree. So what happened in that deal was eventually they come back down to 480, and they're like, hey, we made a deal at 480. But I panicked, but I wasn't understanding that I should be looking at for the benefit of my borrower. And even if the appraisal came in lower, the appraisal system is designed to protect the borrower. Why? Because the realtor makes commission off of the purchase price. They'd rather sell $1 million house than a $200,000 house because there's more commission for both sides. So the higher they can get it, the better for the realtors. Even a little bit for the loan officer too, because we get paid commission off the loan. So the appraisal system is designed to protect the borrower. And if the appraisal comes in lower, I now say, hey, listen, that's what the market is. Because the appraisers, they're pretty dead on. They can get them a little bit off, but they're pretty dead on. So the reason people choose conventional is because they don't want to deal with the appraisal higher bar, which is better for the borrower.
Oh, Athena, you're 1,000% correct.
1,000?
How I find out credit report shows joint, and AKA you can't hide
Yes,
nothing.
sir, yes,
Just be honest with us, that's all. We'll get you a house still. Mommy of zero mortgage guys. If you give 20% down on a conventional loan, you still have to have 6 month reserves? Question mark?
Question mark. We'll throw a question mark on the end of that for you, Mammy of zero. Here's the answer, and it's going to depend largely on your FICO score. Because the 20% down mitigates a lot.
Yep.
Because it takes away a lot of risk. But if you're just barely qualifying, there still is a little bit of a risk, and the bank wants to make sure you can make your payment. Now, what a reserve is can I make PITI, principal, interest, taxes, and insurance, for 1 month or 2 months or 3 months or 4 months? So if I lost my job the day after I funded this loan, can I pay it for a month or 2 or 3 or 4 or 5 or 6? That's what a reserve is. And if you have a very high FICO score, that means you've been paying everything on time for a very long time, and you'll figure it out. But if you're just barely qualifying, even if you drop 20% down, they're like, yeah, you're putting 20% down, so no mortgage insurance. This is a good loan, but you're 621 FICO, so we want 3 months reserves. So DU, which is the desktop underwriter, the algorithm factors this in all the time. Now, there are ways for us to get around it, and we can do a manual in certain situations where we go to Athena and we go, hey, listen, here's the problem. They don't have 6 months reserves. Can you manually look at this and see if it would work? And you need a certain debt to income ratio and a certain FICO score in order to go manual, but that can happen in that situation. So the answer to your question is, sometimes you'll still need reserves, sometimes you won't. FICO determines.
Right. DXO Connoisseur, this is for all you guys. Get ready to screenshot. I always get my questions answered when I get back to work. May I text the numbers with questions? So the answer is yes. Time for commercial.
If you need a badass loan, call a badass loan officer. You can reach your badass loan officers, Chris and Lee, at New American Funding by calling or texting this number. Hey, if you text us right now, we won't even know because we're on Do Not Disturb. And we don't even get text unless it's my mom calling. Or his mom. Or he forgets to hit the button. But at the end of our live, you can call. You can actually talk with us. And we are, yes, we're celebrities. We know that. Yeah, often we get the call. We're like, hey, I feel like I'm talking to someone famous. All right, cool. Let's get you a loan.
Well, every time I get pulled over, I give him my autograph.
Do you? Yeah, good for you. Yeah, that happens all the time. Anyway, screenshot this, text us, call us. We'll help you out.
Boom. There we go. There you go, D. Hope that helps you out. Get back to work. Don't be late, okay?
Yeah.
Boss doesn't like that.
Yeah.
Jariah 5954. I'm an RN. Just became a nurse practitioner. Will my new job income count less the 2 years?
Jariah, oh, I love this scenario. I've done it a few times.
One.
It's a great scenario. Here's the scenario, okay? We're in LA. So in LA, nurses get paid a boatload of money, like a boatload of money. RN, full boatload of money. So let's just say you went through nursing school and you came out with a nursing degree, certificate, whatever it is, and you are now an RN. And you started at one of the beautiful, name a good hospital. Kaiser. You started at Kaiser and you're making
Cedars-Sinai.
And $150,000 a year. Can they make that kind of money? They sure can. Certain nurses make a boatload of money. So you're making $150,000 a year, and you've only been on the job for 1 month. Only for 1 month. But for the last 2 years, you've been in internships, in school, drawing blood or whatever nurses do, and you've been doing that thing for the last 2 years. You only on your job 1 month. 1 month, I can get you in a loan. And I don't even care what you made before. If you have a salary, an offer letter, or a guaranteed hourly and a guaranteed amount of hours, I'll use that higher amount. I won't even have to factor in the old stuff as long as it's guaranteed. Underwriter, check me on that.
Yeah, there you go, Jariah. Time to apply for that loan. And thank you for the love, for sharing the live. Everyone, keep tapping that screen. We need a bunch of those hearts, and I need some shares. We need to get more people in here asking questions.
Mammy, 757 for credit score. That's amazing credit score.
All day.
Conventional. You're like a prime borrower. You're like the 757 is a very good FICO score. You guys are
Rise to the top.
Rise to the top. Keep rhyming.
Non-stop.
Dude.
Oh, watch this mic drop.
All right, whatever.
That's a dope beat.
That's a dope beat, man.
Giselle, thank you for the love. Athena, 2-year income can be used if it's the same line of work.
Yes, that's it.
There
Thank you
go.
guys. You are the
from the underwriter, from
Mammy
the
zero.
loan officer.
Mammy is zero. Mammy is zero.
So what's going on, guys? We need more people to put questions in the chat. So
we appreciate the hearts. Whoever's hearting us up, we appreciate you very much. We see you on YouTube. Appreciate you on YouTube. We see you on Instagram. Not of questions on Instagram, man. We usually get a lot of questions on Instagram.
You know what happens?
We
on
see
Instagram?
you on TikTok. We see you on TikTok, and we see you on Facebook. Facebook? Yeah, it's okay. Yeah. So we got a following on all of them. Hey, Congress just passed that TikTok's going to be banned. Well, it's not really banned. It's a weird situation, but somebody came on my TikTok and said this. Hey, you want to know why this app is going to be banned? Here's why. Because on any given day, any one of us can create a video and accidentally 2.5 million people will see it. 2.5 million. Do you know that 2.5 million people is not what Fox News gets, what CNN gets, what MSNBC gets, what any of the broadcasters get, not for the whole month. 2.5 million views in that one segment. That's why they're afraid of this, because they kind of hacked the system, man, or they figured it out. I don't know if they hacked it, but they figured out the system. They get a lot of people on this app. Now, I do like TikTok. I do like Facebook. I do like Instagram. I hate it when somebody says, oh, Facebook, you must be old. Ouch. because
Facts.
facts.
It's always
I'm like,
stupid kids.
yeah, it's always stupid kids, and you can't say stupid.
Yes, you
so,
can.
and then we're like, no, you don't understand. If you say MySpace, that's when you know you're living in ancient days.
All right, guys.
Anyway,
So in the event that TikTok ban does take place, I need you guys to screenshot this and go to our other locations because we stream to all these platforms every single day. The Facebook one's my private one, but if you message me, I'll get you the information to get there because you never know where we're going to be on Monday. Who knows what's going on in Congress?
okay, Elite Gods. Elite God says, how long does it take to close from when you find a house? So, Elite Gods, most escrows will be 30 days. Most. But if you really want it in that house, I get this often. Hey, Lee, we can jump ahead of everybody else if we can close within 17 days. Can you do it?
Ooh, love it.
I'm like,
I love it.
I can, but here's the catch. Here's the catch. Everybody needs to be on board. And I'm going to tell you where I'm going to hit the hiccups. The hiccups are going to be either the borrower's not going to get me the stuff quick enough, sign their disclosures quick enough, or whatever. And then here's the other hiccup. Escrow is not going to care that I'm a priority. They're not. And do you know who we need to be on board in order to make that happen? Listing agent. Why? Because escrow works for the listing agent. If the listing agent pushes escrow, I'll be important. But I won't be important because I said I'm important or because I said my borrower is important.
Tries every day.
I try it all the time. So when somebody says, can I close in 17 days? I say, yes, as long as the borrower is on board and ready to do things quickly, because that's a big one. And then when we get to the end, the escrow's on board, but I need the listing agent to push escrow, and I need ability to call the listing agent and tell them to push escrow. If I do that, I can close in 17 days. I do it often. But those are the two hangups. Most escrows are 30 days. Sometimes with contingent offers. Contingent means I'm selling my house here and buying the new house here. So I need to close this one before I buy this one because I'm moving 200 grand from here to here. That's called a contingent offer. Those ones are usually 60 days. 60 days. I've seen them as long as 90. But your average escrow, 30 days. I can push it 17 days in a perfect scenario. Fastest I can close?
8 days.
8? You can close in 8?
I think so.
I think so too.
Here's another thing, guys. Thank you, Jirai. You guys are the best.
Appreciate you, Dry Man.
Here's something very cool. It's very smooth. It's very new. And it's only right here through Chris and Lee at New American Funding.
Smooth.
It's a program called NAFCash, okay? It's a program called NAFCash. Now, we've heard from Athena that, summer's going to pick up, which is the one thing that I forget. I forget that summer's going to get real busy, guys, and it hasn't been so busy in our industry, so I forget that summer's coming and it does pick up. So you have a whole lot of reasons of why there's a bunch of people that are going to come in and buy houses and why it's going to be difficult. But we have this program called NAFCash. So what it does is you get qualified with us. Let's say it's conventional. You put in 20% down, regular loan, not a big deal. Okay. Well, we take that approval, so we get an underwritten approval. So Athena says, of course they can buy. Chris and Lee packages are fantastic. Then we send it to our NAFCash department, and they approve you to buy in cash. Okay?
What? Cash?
Cash.
No way.
So let's just say they're buying a $500,000 house.
Cash?
Cash.
Wow.
No, they're financing. Then we get approved for NAFCash. NAFCash will purchase that house, $500,000 in cash.
So they just show up with a briefcase, clip the thing open, boom, 500 G's?
Yeah, basically.
That's badass.
And if we need to close in 5 days, 10 days, 15 days, however fast they need to close, we can close in cash. So what that does is, let's just say that's being sold for $500,000. They get a $500,000 FHA, a $500,000 conventional, a $500,000 VA, but these take 20 to 30 days to close. Sometimes people want to close in 60 days for whatever reason. And then they see this cash offer. What do you think happens to that cash offer?
Goes to the top.
Floats to the top of the pecking order. So they go, I like this cash one. And this is guaranteed because if something goes wrong with the bank, if they lose their job, if someone, something happens, this cash one doesn't fail. So your opportunity to get your offer accepted skyrockets. And with that, you get your house. Now, after the fact, so it closes in cash. Let's say it closes in 10 days. At that point, we start your loan. Okay, you can actually move in inside of that 10 days too. So take your apartment stuff, move it into your house, and then we start your loan. 20 to 30 days from there, your loan is done, but you got the home of your dreams and you didn't miss an opportunity. So if you guys are interested in something like that, don't forget to call us.
Yeah, it's technically 2 transactions, 2 escrows, and it's the same escrow company, but the first one is the bank buys it from the seller. They're like, here's $500,000, we'll take your house, that's it. Now it's in escrow. Now we immediately open this escrow, which means, hey, we don't want to own a damn house. We bought this for Joe Smith. So Joe Smith, we're going to finish up your loan. That takes regular loan times, but in the meantime, there's a lease back so that you can get into the house, and you have to pay for whatever the monthly fee is for the lease back, and boom, you're in the house with cash, extra power for you.
Yeah, Nadine said, do you find the home also? That's going to be the badass agent that we team you up with, okay? Anywhere in the nation, if you need a badass agent, we'll team you up with one. If you already have a badass agent, then yeah, they will help you find the house. We just deal with the financing side, but we have so many relationships across the country that if you do need a good agent, we can set you up.
We can find you that agent, no doubt about it. But we don't find you the house. We don't. You have to find the house, and you find, hey, this is the home of my dreams. All right, cool. I want to go NAF cash. All right, we already qualified. Here, just drop 500 G's. That's your house right now.
Moving.
Right now.
Paint the walls.
Yup, right now. NAF is, so the reason that exists, there's something called proprietary programs. Proprietary means that the bank has a whole bunch of extra money and they have to do something with it. And what do they do with it? Well, New American Funding says, well, we got this, I don't know, $500 million extra this year in our left pocket, whatever. So what we're going to do is we're just going to buy houses on behalf of our clients and then sell them to our clients. That way we can take a piece of the market that the rest of the world can't get. And that way, next year we don't have 500 million extra, we have 600 million extra. So that's their way of doing things. There's a few proprietary programs that we have. One of them is NAF Cash. One of them is a zero down program for 620 FICO. What? Yeah.
Got it. Lorna Castillo, VA loan question.
Mm-hmm.
Spouse just entered into an IRS payment agreement. How long do we have to wait for approval?
Lorna, oh, this one's gonna be a good one. You're gonna like this one. Get some popcorn on this. Get some popcorn. Here's what it is, okay? If you're good with the IRS, what does good with the IRS mean? Hey, I just filed my taxes for 2023 and I owe $20,000. All right, cool. But I know I owe $20,000 and I'm going to voluntarily enter into an agreement to pay off that $20,000. I'm going to give you $300 a month until it's paid off. Now, I voluntarily did that. Cool. No pause, no hesitation, no nothing. Why? Because it's last year. You knew there was a problem. You addressed it. The IRS won't have any problem either. They're like, hey, yeah, we got no problem. We're going to charge you interest, but we have no problem. We'll take that $300 a month, and you can pay us back over, how long? The longest you can pay?
7 years.
7 years.
84 months.
You can pay over 84 months. But that's if you were only last year, you weren't delinquent, you just owe money, and you voluntarily entered. So when we go into qualify you, we're going to need the offer installment agreement and your first payment. Actually, you don't even need your first payment if you did it this way. Just your offer installment agreement. That's all. But if you didn't file for 21 and the IRS sent you some notifications and you didn't file for 22, and then you finally said, oh shit, I'm going to get a house. I better solve this IRS issue. Oh God, I owe 20 grand. Okay, let me see if I can get into an offer installment agreement. That changes the game. Why? Because the IRS had to chase you. You didn't voluntarily step into it and say, I have a debt and I'm going to deal with this debt. The IRS had to chase you. And once they chase you, they put it on the system, on the board, you're delinquent. Every underwriter out there is going to say, okay, I need to see all tax years. I need to see that you're in good standing with the IRS. I need the offer installment agreement, and I need the 3 most recent payments on time. Not 3 payments all at once. 3 payments over 3 months, and they have to be current. Then I can take that payment amount, factor it in, and move forward. 2 different ways to deal with the IRS. One is you voluntarily saw an issue, you solved it. no harm, no foul. Everybody says, all right, yellow issue, you're solving it. The other one is the IRS had to chase you. And if they chased you, changes the rules kind of a lot.
Okay, and I'm reading it a different way too.
Okay, cool. Tell me.
How long do we have to wait for approval? I think what she means is she submitted, they did an offer installment agreement online.
Yeah.
And then they got the little thing that said, hey, how much do you want to pay? How many months?
Yeah.
You get to choose. Now, after the fact, the IRS hasn't sent you the approval yet, and banks need that in most cases. And that takes 1 to 2 weeks. But if you are not receiving that, I have gotten a loan approved without it.
What?
And closed.
What?
So if you're struggling with that, Lorna, give us a call. We'll figure it out.
And let me give you another little insight to the world, okay? Banks. The reason mortgage insurance exists is because they're worried that the borrower is going to default. So the reason that FHA has 0.55 and then 1.75 UFMIP, don't get me on that train, but the reason it's there is because they're worried that the borrower is going to default. So there's mortgage insurance on FHA. The reason that there's mortgage insurance on a Fannie Mae and a Freddie Mac is because they're worried the borrower is going to default. The bank's always worried the borrower is going to default. But on a VA, the VA steps in and says, I'll guarantee up to 25% of this loan. What? That's why there's no mortgage insurance. Because the VA steps in and says, I'll guarantee up to 25% of this loan. So the bank goes, wait a minute, if this borrower defaults, the VA will make us whole? I ain't got nothing to worry about. So much easier underwriting. So much easier. So Lorena, VA loan, you by the way, get a good LO, if you're not going to use us, I recommend you use Chris or I really do. But if you don't use us, make sure your LO is really skilled, because if not, it will cost you a lot of money in some areas that you may not even know.
Mitzi Aguilar, random question. Why are the images flipped on the TV?
Mitzi, good question. Very good question. Mitzi, we are on Facebook, Instagram, TikTok, and YouTube all at the same time right now. And our tech guy was able to flip it on 2 of the platforms, but not on the other 2. So in order to split the difference, what we did is we created the image and then we flipped the image for the other platform. So depending on which platform you're watching us on, you'll be able to get the information, and then you'll be confused for a second, and then you'll ask that question. We get the question a lot. So thank you, Mitzi. Appreciate you.
Dean, okay, great. My husband and I are looking for a home in South Carolina. Is there someone you can recommend there? Absolutely. Who would you recommend there, Lee?
I'm going to recommend you call Chris.
Boom. And I recommend you call Lee.
I appreciate you for that. Hey, so here's the other thing. We deal with a lot of top producing realtors, counts up. Top producing realtors, top producing. And these top producing realtors pay anywhere from $1,000 to $5,000 a month to be in a group. So this group is all across the nation. So let's just say you're in North Carolina in a city I'd never heard of. Never heard of. I'll call my top producing realtor and I'll say, hey, listen, can you recommend a realtor that works in ABC, North Carolina? And my realtor is going to say, hey, Joe Schmo works in ABC, North Carolina, has closed 70 transactions in the last 6 months, and has been in this business for 15 years. Would you like for me to give him your name? Yes, cool. Now, Lee, I will call Joe Schmo, and I'll say, hey, Joe Schmo, I got this client. I got him qualified. Yeah, I need to talk with you a little bit, but I was wondering if you would take on a pre-qualified client. Are you able to do that? Every realtor says, well, yes, I will. Now, will you give them the time that they need, Joe Schmo? Well, of course, Lee, I'll treat your client great. Joe Schmo, I need you to know something. I need you to know my fiduciary obligation is to my client. If my client is not happy with your services, I will replace you. And then he gets a little offended for a second. He goes, well, I expect nothing less, Mr. Duran. They start calling me Mr. Duran at that point. I say, okay, cool. I will be checking on you. I don't care what your process is, as long as my client is happy. Now, what I did by doing this is, in order to afford $1,000 to $5,000 a month, you already have to be a top producing realtor. You have to know your market. You have to know your systems. You have to know how to negotiate. There's a lot that before you get to that level. And because you're my client, I actually understand the system, and I understand if they're screwing you over and they're not doing a good job, and he knows I'm watching. So this is how we get you a great realtor.
Yeah, Lorna Castillo said correct. It was submitted and waiting on the official approval. So yeah, give it a couple weeks. It'll be there. Also, you have a portal with the IRS. Log into that. You'll get the data there faster than receiving the letter in the mail.
Yeah.
GXVGE, real talk. Could I use projected income from the business being constructed to help with applying?
So GXVGE, I'm going to assume you're a brand new young entrepreneur. I'm going to assume that because you're starting with real talk. And most business conversations, it's just implied that it's real talk, but could I use projected income? Projected income. So the simple answer is no, you can't. No. Why? Because I project I'm going to be a billionaire by next year. Can I use that income? No.
You really project that?
No.
No?
What I can do is I can use the last 2 years of established income and prove that you're on track to project the same amount of income in the future. In that scenario, projected income works, but you have to have actualized some income before I can do that. Because I can't just go, hey, here's my business plan. I'll be a billionaire by Tuesday. Just lend me some money on that. Yeah, that's not real. That's not real talk.
Yeah, Lorna Castillo, we have 28 DTI with IRS payment. Y'all are ballers. Good job.
Lorna, that's great.
Good
Let me
job.
give you. I'm gonna give you a hint. Okay, first off, I'm a veteran. My dad's a veteran. My son is Special Forces, U.S. Navy right now. Like right now.
You didn't
Scary.
say that fast
Respect.
enough,
Yeah, I
man.
know.
Special.
Force. Well, I'm just like, oh, he's deployed. He's deployed. Oh. Anyway, so here's something. When you become a veteran, you get a certificate of eligibility from the VA. So your certificate of eligibility. If you have a seasoned LO, somebody who knows what they're doing, loan officer, that's me. So if you have a seasoned LO and he pulls the certificate of eligibility and it says non-exempt, it's going to say non-exempt, it's going to say $36,000. You don't have to worry about those numbers. I can explain them, but you don't have to worry about those. If it says non-exempt and you told your loan officer, hey, I'm getting $133 a month from the VA, the loan officer should have known that you're 10% service connected and should know that that non-exempt is a false positive. And you go, wait a minute, can you send me that letter that shows you're getting $133 from the VA? Well, yes, I can. Cool. It's going to say service connected 10%. Then you're going to go to the VA and you're going to say, this certificate of eligibility is incorrect. Here's the paperwork to prove it. The VA is going to go, why, you're correct. It hasn't made it through the system yet. And then they're going to give you another certificate of eligibility that's going to say exempt. Now, that little move is going to save you up to 3.3% of the house. Well, wait a minute. What is that? 3.3% is the funding fee on some VA loans. And if you have a $500,000 house, that's upward of $18,000. Now, if your LO does not know, go do that. If your LO does not know to do this, you will pay that funding fee and you don't even know you did not have to pay it. That's a very big deal. There's actually an industry where they go after the VA and go, hey, I should have never paid this funding fee. I was service connected at this point and they charged me. And there's an industry, and the industry is because the LO is not good enough to catch it in the beginning. Anyway, sorry, got a little pissed off. I got a little heated there. I got big mad.
Okay, GXVGE said I have an established dealership building a second one, but want to use projected income to build a house.
To build a house, well, if you're building a house, if you're going with your conventional, there's FHA one-time connect. What's that?
Everything blinked.
I didn't see
Weird.
it. Oh, dude, maybe we're in the Matrix.
Ooh, I like it.
So if you have a dealership and you have established income already, then you are a seasoned businessman. Much respect to you. Erase what I said about being a brand new. Projected. I might be able to do it. Maybe. As a jerk. Sometimes I am a jerk. Whatever.
Sometimes.
Yeah.
Lorna, Sasha, Jariah, user.
Appreciate you
love.
guys.
How long is the pre-approval good for?
So a lot of people tell you that it's good for 90 days, and it's kind of true, but it's good for as long as you need it. Here's why. At 90 days, I have to do a refresh. I have to make sure you're still employed, your credit's still the same. I have to make sure your liabilities didn't go much higher. But all I do is a refresh, and it keeps going until you get your house.
Yeah. CCG, 450 credit score, want a $900,000 450 score on a $900,000 home. What do I get? Right.
You keep dreaming, CCG 450 credit score. You're just playing me, man. There's no way you know it. Come on,
I've had one of those.
come on. You've had a 450 credit score? Not got a house, but
No, I didn't get a house.
You don't get no house. You don't even get you can't even get a
Robert
sandwich.
and Isles. What's a good score to get a house? Not 450.
Yeah, not 450.
Start
FHA minimum requirement is 580. Conventional Fannie Mae Freddie Mac 620. But ideally, you should be in the 7s or 8s. That's a good score to get a house.
Nana's back. Hello,
Nana.
long time no see.
What's up, Nana?
I've been home this year for 6 months because of surgery. If I want to buy next year, which W-2 I need?
The most recent. Yeah, it's always
yeah.
going to be your most recent W-2. Your 2 most recent W-2s. And we can maybe use a W-2 only program. Talk to us. We'll help you out.
And FHA, just so you know, FHA will ask you to be back for 6 months before you can use that income.
What?
If you've been off for 6 months or more.
Yep.
Texas made. I have a paid off home, but I have poor credit. How can I pull money out of my house?
Yeah, you're in trouble, Texas. I don't know what poor credit is. So it depends on what you call poor credit. Some people call 647 poor credit. Some people call 450 good credit. So it depends on what you guys call poor credit. But getting money out, rough. It's debt to income ratio. FICO scores that's the qualifier. If you have a low FICO, I can't even put you in programs.
Yep.
But if you have a high enough FICO, then I can open up the programs and we can talk about what we can get you out.
Yeah, Dennis the Tech Guy. These guys are the best.
We appreciate you, Dennis the Tech Guy. We appreciate you.
Bobby F. What can I qualify for 90K income and 790 FICO? Bobby F. Is that Bobby Flay?
Bobby
Bobby
Flay.
Flay watching our show?
I'm going to say
No debt.
380, probably 380, you think so? 380? Yeah.
Athena coming to the table, getting an audited P&L. That's the
Yes,
dealership
that's
guy.
correct. The audited P&L. If you have a 2-year history and then you have an audited P&L, we can use the forecast going forward. But if you're a brand new business and you have an audited P&L, it ain't going to happen.
Yeah, Dennis the Tech Guy just closed on my house last week because of Lee and Chris and the team.
We appreciate you, Dennis. We're so happy to get you that house. We appreciate you.
Dude,
CCG,
I
you
told
crushed
you.
your dreams.
Jerk. Jerk.
Crushed the dreams. Sorry,
Jerk.
didn't want you to crush your dreams.
And then Juan comes in. I have an 851.
I know
credit
Juan's
score.
like, yeah, I'm flexing. There is no 851. It's only 850. Well, I hate to tell you this, but FICO tops out at 850.
All right,
And I'd really like to see that 850. Damn, 380K.
Bobby Flay, your
Bobby
income
Flay,
is much
dude.
higher than that.
Yeah, much higher than that. Yeah, ready?
Yeah.
Hey, you know what? We've been Chris and Lee. We appreciate you guys. We'll be back.